Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated. And there has been a continued volatility in all of them, especially as we see the equities markets hitting all-time highs, which we do touch base on here. The dollar index is a market in itself, has not been without its volatility. And then certainly the precious metals prices, it should make for a healthy show today. Glad to have Rob and Miles and myself together again. And so Miles, without further ado, what do you want to talk about in terms of first charts, most important charts of the week?
Oh, I want to talk about a couple things this week, but maybe we should start where we're supposed to. I'm a rule follower, as you guys know, big fan. So we start with gold. This is Golden Rule Radio, not Dow Transport Radio, but we're going to talk about that today too. Yeah, so starting off with gold. Gold's been in this great little trading range going back to the end of November between about 2000 and 2050. We did have a couple of bumps above it and below it. As you guys are aware, a few weeks ago, we did put in that all-time high, I think 2148, 2149. And then we had a nice little correction back down to your short-term 50% line. I believe we talked about that last week. And now we're back up into building this trading range just above 2,000. So unless we see some significant movement down, your longer moving averages are starting to move back up towards your 200 days around 1955. So we certainly have some room to go down if we had to. We're talking this move starting back in the low 1800s, 1800 to 2150. Is a pretty significant move. We've had a 50% retracement. We're sitting above the 382 now. And at least trading over the last couple of days looks relatively flat after the bounce off the 50. So I would argue if we're going to see gold continue to go back up, I think the line in the sand right now is 2053. I would like to see gold above 2053. If we're going to argue a push back up to that all-time high and probably above the all-time high if we hit it again. On the downside, if we're going to see gold turn back down and head back towards that 200-day moving average, anything under about 1980, and I would be looking for lower pricing at that point. So yeah, gold in between levels, in between obviously very, very significant levels when we're talking about what our fifth all-time high in the last 3 years, I think fifth time now. So gold looking very strong despite some Fed announcements last week that I know we mentioned and I think we want to continue to talk about this week.
Before we get into the white metals, because we have some things to talk about there, what do you want to bring to the table, Tori?
This probably is a good time just in terms of what are the fundamentals that drive gold. Honestly, there are a lot that are pushing and pulling on the gold price, and we talk about those on the show. It can be treasury yields, it can be dollar index strength, it can be stability or instability in other markets.
Geopolitical forces.
Huge. Geopolitics, debt, deficit spending, money supply is your big one. That sort of stuff. Yeah, the Fed balance sheet. All of those things are what we have to look to, not only to make sense with hindsight as to why something occurred price-wise, but to hopefully predict for the sake of our investors with timing. And we don't always invest on timing and price, but all of those are key. And to me, this week, it has become about, much like what Miles touched on last week, my fundamental of the week is politics, not geopolitics. It's domestic politics because of the actions of the Federal Reserve, the U.S. Treasury, and Washington. We knew the Treasury Department was political because the Treasury Secretary is chosen by the President and obviously confirmed by the Senate. However, what we are supposed to have is a completely independent Federal Reserve. The central bank is supposed to be apolitical. Well, does it appear that way to you?
No, not in the least.
And I know we touched on this last week, but look, this rate hike is why we saw the most recent spike. So Miles' chart, he'll always say, we're going to end up at certain figures in timing. And what we have to try to do is, okay, what's going to get us to that number first or that number first? Is there going to be a bullish or a bearish fundamental? We didn't expect the Federal Reserve to come out and say, hey, there's going to be 3 rate decreases in 2024 and then more in 25 and 26. So we get that 60-point jump and it's like, okay, there's the fundamental, but nothing's changed. What we just heard Miles say, we have not changed in terms of breaking out into some new channel on our way to the new high necessarily. And normally we tend to kind of limp into December, right? December, the
Exactly.
close of the year tends to be
A little soft.
slow,
Yeah.
right? And demand is lower. And well, if this isn't political, then it's certainly buddy for Wall Street, because the central bank has certainly padded the pockets of all money managers, wealth managers, stockbrokers.
Well, they've
Wall
got to
Street.
get their year-end bonuses in, Tori.
Well, what was one of the arguments for interest rate rises? They want to increase unemployment. They thought employment was too high, which I don't know anyone in the U.S. that wants a job that feels like employment is too high. And they wanted to cool off the economy a little bit. But
Yep.
realistically, when you look at, say, the Dow Industrials compared to the Dow Transports, the economy's cooled, but the stock market is not. And I think we need to stop thinking the stock market is a barometer of the economy,
Good
because
luck with
most
that.
of the money, most of the money in the stock market is leveraged. It's not you and me. It's not us investing. It's banks borrowing from each other to run the price up for the sake of your hedge fund management. So
Yeah.
how can it not be political? Like, that's the part that I agree with you. That's the part I get very frustrated at here. How can this not be a politically motivated announcement coming out of the Federal Reserve Bank, a quote unquote independent, or at least apolitical organization? I don't get it.
Yeah, we're going to cut rates 3 times in 24. But then the new administration, which is going to be a Republican administration almost certainly.
Well, it was looking that way, but go ahead.
Yeah.
Sorry.
So they're going to punish the incoming quote unquote conservative administration in 2025.
Oh, that's just such a huge point. I'm getting distracted here, and I'm going to spider web like crazy, so try to stay with me. I'm going to try to stay with myself in my head here. But that sabotage, think about it. If the Democrats don't win re-election, what they just did is what Miles just said, and that is drive leverage. You drive leverage, you drive speculation, you drive the markets higher. What do? You drive inflation. And so there's a great chart that shows that we tend to go through these 3 spikes of inflation. The first 2 are smaller than the third big one, but we just finished our second one, and the next one's going to be even worse. And inflation hasn't turned into deflation. It's still inflating at a higher rate than 2.3%. So that didn't change. That wasn't a motivation, as if inflation had shrunk below the 2% mark. But the next administration, be ye Democrat or be ye Republican, you've just gotten sabotaged.
You got a poison pill,
Yes.
courtesy of the Fed.
Yeah, you absolutely did. Now, to me, this reeks of saving Biden at all costs, because Trump is up now 10 points in most polls, assuming he's the nominee. And our state of Colorado just said that he can't be on the primary ballot. So we're going to see if that's even possible. But he leads in all 7 swing states right now. That's doomsaying. And as Clinton ran, it's about the economy, stupid. So if the economy continues to turn down, they can't afford it. So to me, all they had to do was come out and say, no more rate hikes in 2024. But that's not what they said. And now they're backpedaling on it. They've juiced the markets, and now they're backpedaling on it. Fed Governor Williams comes out and says, well, that's not a guarantee. We don't necessarily know we're going to cut rates in 2024. Well, you already said you were. So half the time it's what they say versus what they do. But that to me is a big one. And it's good for gold. This is what you have to understand, is that leverage, balance sheets like you're talking about, which the Fed balance sheet, by the way, is increasing. It's up a couple billion just in the week. So keep your eyes on the Fed balance sheet, because that's quantitative easing despite what they're saying. That is good for gold. It has driven the dollar index down. That's good for gold. David McIlvaney made a great point in our meeting yesterday talking about, remember in 2009, 10, 11, the dollar index after TARP and QE1, QE2, QE3, the dollar index went down into the 70s. Right now we're 102. So what happens when gold is starting at $2,030 an ounce with the index at 102 and the dollar index goes to 70? Where's gold? I mean, pick a number. So that's a very strong fundamental. It's okay if it's political. Unfortunately, the fallout is, Miles, you talk about the economy, and the economy is not growing. Well, there is a big, almost record boost in GDP. It's up 5%.
How do they calculate GDP again?
Well, I'll tell you how they get GDP to spike. Yeah, exactly. Who cares how you calculate anything anymore? But the 5% spike, that's all government spending of dollars we don't have. Government spending driving GDP so they can brag about economic growth and they're spending borrowed dollars that they don't have that we have to pay for down the road. And now here we go. The official national debt is right on the edge of hitting 34 trillion. We just talked about 32, 33. Now it's 33.93 trillion. First of the year, 34.
And they'll have to refinance 14 trillion by 2026 at a higher interest rate, which drives the debt service. Everybody knows about running up credit cards and paying that debt service. Well, the feds run up their credit card. Their debt service is going to continue to absorb a greater percentage of our federal budget. That's another poison pill that's coming very soon, within the next 2.5 years.
Another politically motivated one.
Yeah.
So you're exactly right. So all eyes on gold. I know it's easy to focus on gold as the money metal. It's easy to predict that gold's going to be much higher based on everything we just said, certainly through 2024.
Well, and everybody keeps asking, hey, I've heard all these wild predictions for gold. Nothing seems to happen. It seems stuck, and they, quote unquote, manipulating it. I don't even want to get into all that, but it's a good question. Why hasn't gold broken out yet? Well, it will when it does.
Well, when we did the show earlier in the year about the tripling effect in the gold price, I mean, Miles and I broke down all the historical precedents for a tripling in the gold price. What was it, Miles? 6 or 7 cycles that we've seen where gold has tripled in price over an economic cycle.
Yep.
Are we starting this?
Yes.
Miles, I'm going to ask you this as the chart guru. Are we starting at 1,050 where we were January 1st of 2016? Or are we starting at 1495 where we were in 2020? I mean, what's the start of this macro cycle where gold would triple from?
Personally, when I'm looking at market cycles, I feel like there's an interim time between, say, the end of a bear and the beginning of a bull, or vice versa. The dollar price that a bear market ends on, and then you tend to have a period of time where it needs to reconsolidate and kind of start marching the other direction. So I would generally argue that you're actually looking at the start of a bull market being spaced out, not at the 1,050 bottom, but more in that 1,500 range where it actually started marching up again.
Okay.
So that would be my argument, the way I personally look at charts. I don't do tops and bottoms. I do beginning of trends.
Yeah, I completely agree. And what is that, 4,000 plus gold from there? And that's conservative. That sounds like yay for the gold owner. No. Bad for the dollar investor and the person that's spending in U.S. dollars.
Well, that's just gold playing catch up.
Right.
I mean, look at the cost of living increases over that same period of time. Gold isn't the front runner here. Like gold doubling or tripling from those types of prices, that's gold just catching up with the damage that's already been done.
That's right.
That doesn't even account for any type of speculative buying that could end up going into the gold market as we start approaching highs. You know, when the general population gets emotional and gets involved, then you start to have actual problems. And we saw this happen last time. Gold goes from, well, when I came to work here, $350 to $2,000 over the course of 10 years. Well, and then it had to settle back down to 1,050. Well, there's your tripling. 350 to 1,050, not 350 to 2,000. So what if we're talking gold from 1,500 to 10,000 and then settling back down at the tripling? Those are the types of numbers I'm actually concerned about, because now we're talking, could gas be $5 again? Well, that would have seemed astronomical in 2001, but that's not as shocking today to say, hey, gasoline could be $5 a gallon at the pump, and we'd all
As a
go,
new floor.
Yeah, sure.
Yeah.
Sure it could, because we were just almost there.
That's right. And so here's the takeaway. We've got to get to the white metal. Sorry, you guys. I'm dragging this out. But the lower the lower rate means increased money supply. It drives credit, drives money expansion, which means weaker dollar, which means higher gold. There's your flow chart. That's just the nature of it. And that's what we've been living under for our lifetimes. This trend is not interrupted. It is not broken. It is continuing. Who cares what the gold price is going to be? It's why you save in gold instead of sitting in dollars, where there's a hidden theft, a hidden tax, where it's robbing you every month unnecessarily as an unsecured creditor in a bank. So here we go. White metals, Rob. What's piquing your interest? Silver, platinum, palladium. Let's talk about the sisters.
Well, obviously, palladium has stolen the headlines. We were in the 940s just 10 days ago. And as we're talking right now, palladium is at 1209. Let's call that a 30% increase. At least a 25% increase. I'd have to take my boots off to do higher math. In a very short time.
Please don't do that in the studio.
So palladium, very quietly, has done amazing. And then when you look at where it comes from, I mean, about 40% of the world's palladium plus minus comes from South Africa, 40 to 45% comes from Russia. These are countries that are definitely in the orbit, that de-dollarization orbit, the BRICS orbit. And then platinum, 70 to 80%, it depends on who you read, of the world's platinum comes from South Africa. And that's not a stable country in spite of the orbit it's circling in. So we see supply issues coming in those two metals. And then you look at silver, which is still below $25, and you wonder, well, what's going to drive silver? And then I look over at copper, Dr. Copper, which typically signals a move for silver. And copper is looking like it's coming to the end of a 3 to 5 year compression and starting to push up against the upper range of that declining wedge formation. Miles, do you have a chart for copper?
I do. Let me mention palladium real quick, and then we'll definitely talk about copper. So if we look at where palladium ended the bull market in 2022 to where palladium got to at the beginning of this month, you're talking down about 72%. During that decline, we've actually had a couple bumps between 20 and 30% retracements back up. Back in May of last year, we went from 1750 all the way up to 2350. You know, we had another one in March of this year, 13 and a quarter up to 16 and a quarter. So it's not completely unreasonable given the massive percentage decrease in palladium that we've seen something like a 30% jump back up just because of how far it's fallen. You drop the ball 5 feet, it only bounces a foot. You drop the ball off a building, it's going to bounce a couple stories.
Yeah, because we were at 2934 going back to March of 2021.
It topped higher than that, though, on the speculative. As soon as Russia invaded Ukraine, I remember it went like 3,200 on the ask.
Yeah, we had a single day jump that March of last year. That was pretty significant. So I just want to keep that in context. But what could be happening, and this gets back to what I was mentioning a second ago, is palladium has to find bottom and it has to start climbing back up at some point. So there may be an interim time here where we're not going to know for 6 months, but maybe December 6th, we did hit the bottom in palladium. Now, it may not start climbing again for 6 or 9 months. You know, we may play up and down here a couple $100, and it's going to feel pretty volatile because palladium tends to be volatile because of the political pressures that you just brought up and the international and trade relations pressures that are now an issue, unfortunately. So I'd actually be looking for some volatility in palladium, which to me is going to signal, you're right, we are actually putting in a bottom and we might see palladium start marching upwards. So that'll start making us wonder, well, what's that relationship going to be between palladium and platinum? Is it going to continue what it's been doing for the last 40, 50 years, or could there be a new paradigm between the two?
That new paradigm, that's a really, really good point, because we have steered clear of palladium because of the ratio being so askew, the platinum to palladium ratio. Now maybe it does get intriguing with this 30% climb. If we get another chance and it comes back to essential parity with platinum, maybe I am going to start structuring my precious metals portfolios with a palladium component.
Yeah,
because
I agree.
that volatility, who wouldn't want a short-term 30% pop?
Right.
Exit it, you know, and go from there. So we'll do a deeper dig into this and deeper dive, and we'll see, does that impact our advice as we advise our clients?
Yes.
Yeah. So copper, it's copper, right? It's the mercury in the thermometer.
It is.
There's a real market problem when copper, which should be kind of the stable metal that all other metals relate back to in the industrial world, goes up 160% between March 2020 and March 2022. So we're seeing a pretty healthy decline in copper, but I do think it's good to bring out something we haven't talked about in a long time. But copper is a very beautiful chart on the long term. Mm-hmm. You know, we had 155% rise. We had an almost perfect 618 correction back down between March and June of last year. We came back up. It's making, as you mentioned, this beautiful pennant pattern, this compression zone. It's been trading sideways since April. Copper's due a breakout one direction or the other. It's consolidated at this point. In fact, it is consolidated, and when it finished consolidating, it kept consolidating for another 3 months here. So I'm looking forward to seeing what direction Dr. Copper decides to go, because it's going to drag the rest of the industrial market with it.
Correct.
Wow. Great point.
Well, that's going to do it this week for Golden Rule Radio. Thank you for listening. We appreciate your feedback. And Miles, take us out, buddy.
As always, if you liked what you heard, do the YouTube button pushing stuff. Better yet, give us a call sometime. We're happy to talk with you about your personal precious metals portfolio. We can be reached at 800-525-9556. We're also on Twitter at ICA Gold, Facebook at McIlvaney Financial, or you can swing by our website at McIlvaney.com. In observance of Christmas, coming up next week, we will not be recording Golden Rule Radio, so we hope you have a wonderful holiday season with your family, and we'll talk to you after the holidays. Thanks for listening, and have a great week.